While index funds simply aim to track the market, actively managed funds try to beat it. That might seem attractive, but it's not that simple. Behavioural finance expert Joe Wiggins says there are two main things to think about before investing in an active fund.
One is that our tendency is to focus on past performance. So we're drawn towards managers who've generated strong returns in the recent past, which is an incredibly fickle guide to future returns at best. And actually the more extreme positive returns that have been generated in the past, the higher the probability of poor returns in the future. So we're ironically drawn towards managers with stellar records in the past that increases the odds of disappointing returns in the future. So that's a fundamental issue that we have. So if we're going to invest in active funds, it needs to be more focused on skill rather than past performance, which can be highly volatile and random.
So don't be swayed by the fact that a particular fund has recently produced excellent returns. The second thing that Joe Wiggins urges investors to keep in mind is that staying invested in whichever active fund you choose can be very challenging.
If investors want to invest in an active fund, they need to understand the behavioural implications of doing so. And one is you will go through significant periods of underperformance. Even if you look at Warren Buffett's track record at Berkshire Hathaway, it went through significant periods of underperformance against the S&P 500. So the best investor of his generation probably went through prolonged periods of underperformance, periods over which most active fund investors would fire a fund manager. So on typical time horizons, most active fund investors would have fired Warren Buffett at some point.
Most active funds underperform most of the time. But it's not because the managers aren't highly intelligent or hard-working. Most of them are. It's mostly down to the fact that active funds charge higher fees.
When people see the data on active management success against the index or passive options, there's often a narrative around it being active managers don't have skill, they're useless, they're not capable investors. But I think it's a bit of a misnomer. The real difference is fees. There's a yawning gulf between the fees of a passive strategy or smart beta strategy and a fully fledged active strategy. And although they may look relatively minimal over any given year, the compound impact of that fee differential will be profound through time.
You also need to remember that the fund management industry and the financial media sometimes give the impression that more funds outperform the market than actually do. That's mainly down to survivorship bias.
So if you think about the active fund management industry, you'll see managers that have underperformed. They'll lose their jobs, or funds will be closed down, or they'll be merged with other funds that are performing better. So you're left with a biased sample of managers who've generated a strong track record. So that can put a flattering view on the overall results of the group. I think the key thing when thinking about survivorship bias is understanding it as an issue. And whenever you're looking at data, or you're looking at performance tables, or you're looking at aggregate performance of a group, understanding whether it's been controlled for that or whether it's heavily biased towards the survivors in the group, the better performers in the group.
In short, be naturally skeptical. Making sensible fund choices is hugely important. If you're in any doubt, always seek professional financial advice.